To borrow a phrase from a soliloquy in Shakespeare's Prince Hamlet, to pause or not to pause is the question investors have been toying with coming into Wednesday's Federal Reserve meeting. Analysts are generally quite divided on what the Federal Reserve will do. Will the Fed maintain and even extend their hawkish stance by pushing the terminal rate above 5%? Or will the Fed start to signal a coming pause, perhaps seeing some slowing signs of US growth, and perhaps they'll even surprise markets with a lower 50 basis points hike versus the 75 basis points as expected? So if the Fed do surprise to the dovish side, then that would typically immediately boost the S&P 500 higher. Lower interest rates means both lower debt repayments for companies and more spare consumer cash for those consumers to spend in companies. So if we do see a Fed surprise to the dovish side, then the S&P 500 strong seasonals are particularly relevant. Now, over the last 25 years, the S&P 500 has gained a total of 18 times in the last 25 years, and the average return has been 2.86%. Maximum profit has been pretty stellar, 13.47% in 2020. Maximum loss 9.71% down to 2000. Also had a bit of a heavy dip in the global financial crisis of 2008, the downturn in 2018 that generally went through stocks. And the maximum drop, you can see that was a pretty whopping maximum drop of 22% in the global financial crisis of 2008. So a major trade risk here, of course, is that if the Fed take a definite hawkish stance and perhaps surprise markets with a more aggressive approach, that can send US stocks down for another leg lower. Remember, HYCM clients can access the SeasonX product in order to analyze over 25,000 different currency pairs, indices, commodities, as well as individual stocks. So please do contact your account manager for a free trial to get started right away. Certain products and services mentioned herein may or may not be available to all clients, depending on which HYCM Capital Markets Group entity their trading account adheres to.